It wasn't a market error, it wasn't a glitch in the algorithm, it wasn't even a coordinated speculative attack by a group of rogue traders, it was the mathematical inevitability of a leveraged cycle hitting a liquidity vacuum. The arithmetic is merciless. When the claims on a physical asset exceed the available inventory by a factor of 300 to 1, the correction is not a gentle slope. It is a vertical wall, a shock-a-sudden repricing that occurs exactly when the system is least prepared to handle it. The pattern is unmistakable. We look at the charts and we see noise, we see volatility, but if you look at the structure of the market itself, the plumbing, the settlement dates, the delivery obligations, you see a machine that is designed to function only within a very specific band of liquidity. Remove that liquidity even for a period as short as 24 hours and the illusion of infinite supply evaporates. The price on the screen disconnects from the price of the metal. This has happened before. It happens at the end of empires, it happens at the end of currency cycles, and it happens when the paper market becomes so detached from reality that a single day of stress can shatter the peg. December 26th represents more than a date on the calendar. It represents the structural weakness of a system running on fumes. The banks are closed. The desks are empty. The algorithms are left alone to manage a risk they were never coded to understand. This is where the breakage happens. Not in the roar of the midday trading floor, but in the silence of the holiday gap. The incentive is to ignore this risk, to pretend that the paper contract is equivalent to the bar in the vault. But the history of finance is a graveyard of that specific assumption. The risk is not that the price goes down. The risk is that the market for the physical asset goes dark, and when it reopens, the price is no longer what you thought it was. The gap is the history, and the history is about to rhyme. The mechanism we are discussing is not new. It is the oldest story in the history of money, repeated with tragic precision across centuries, continents, and civilizations. The pattern begins with a promise. A state, an empire, or a banking system promises that a certificate, a coin, or a digital entry is equal to a specific amount of physical wealth. For a time, this promise holds, commerce flourishes, trust is high. But the incentive to expand that promise beyond the physical limits of the vault is irresistible. It allows for wars to be fought. Without taxes, it allows for social programs to be funded. Without deficits, it allows for the illusion of prosperity to outpace the production of goods. But eventually, the leverage becomes too great. The pile of paper claims grows so high that it casts a shadow over the real economy, and then usually during a moment of quiet crisis, a harvest failure, a lost battle, or a liquidity crunch during a holiday window, the market asks to see the metal, and the metal is not there. To understand the magnitude of what a modern liquidity squeeze looks like, we must first look to the definitive example of a silver-based empire collapsing under the weight of its own monetary illusions. We turn to the Spanish Empire in the 16th and 17th centuries. This was not a minor kingdom. It was the superpower of its age, the master of the Atlantic, and the owner of the greatest silver mine the world had ever seen, Potosi. In 1545, a native prospector stumbled upon the Cerro Rico, the rich mountain in what is now Bolivia. It was a geological anomaly, a mountain of nearly pure silver, or that would fuel the Spanish war machine for a century. The sheer volume of silver that flowed out of the Andes and into the coffers of Madrid was staggering. Galleons, heavy with bullion, crossed the Atlantic in convoys that were the envy of the world. To the average observer in Seville or Madrid, it seemed that Spain had solved the problem of economics. They had found the source of money itself. There was no need for industry, no need for agricultural innovation, no need for fiscal discipline. They had Potosi, but the arithmetic of the market does not care about the size of your mine. It cares about the ratio of money to goods. As the silver flooded into Spain, the crown, led by Philip II and later his successors, began to spend it before it even arrived. They borrowed heavily against future fleets. They issued debt instruments known as juros, which were essentially paper claims on silver that had not yet been mined. The bankers of Genoa and Augsburg were happy to lend, believing the collateral was secure. The leverage built up. The entire Spanish economy reoriented itself around the arrival of the treasure fleets. Then came the squeeze. It wasn't a single day, but a series of liquidity shocks that exposed the fragility of the system, the costs of maintaining a global empire fighting the Dutch in the Low Countries, the English at sea, and the Ottomans in the Mediterranean began to exceed even the output of Potosi. The crown began to debase the currency within Spain itself to pay for domestic expenses, reserving the good silver for foreign wars they introduced. Vellon, a copper currency mixed with a tiny fraction of silver. At first the merchants accepted it. It was stamped with the king's face. It was legal tender, but the market always finds the truth. The public began to hoard the old silver coins, the ones with real value, and spent the copper vellon as quickly as possible. This is Gresham's law in motion. Bad money drives out good. By the mid-17th century, the premium on silver rose violently. A distinct gap opened up between the official value of the currency and the market value of the metal. The crown tried to enforce the peg they issued decrees. They threatened merchants. They banned the export of bullion. None of it worked. The crisis point often came when the treasure fleet was delayed. A storm in the Caribbean or a blockade by the Dutch would mean the silver did not arrive on time. The liquidity window slammed shut. The bankers in Genoa demanded payment. The soldiers in Flanders demanded wages. But the king had only copper and promises. In these moments, the value of real physical silver didn't just rise, it exploded. Those who held paper claims on the fleet were wiped out. Those who held physical silver commanded the economy. The price shock was absolute. The Spanish middle class was decimated, priced out of basic goods as the inflation caused by the copper currency raged, while the silver they thought they owned had been shipped abroad to pay foreign creditors. The empire that owned the mountain of silver went bankrupt not once, not twice, but 9 times between 1557 and 1666. The lesson is stark. Owning the source of the metal is not enough if you leverage your claims against it to the point of insolvency, just like the Spanish Empire found itself drowning in copper coins while the silver vanished. The Weimar Republic in early 20th century Germany provides a chillingly precise blueprint of how a modern industrial economy dissociates from reality. We often think of the Weimar hyperinflation as a cartoonish event, wheelbarrows of cash and children playing with blocks of banknotes, but we must look closer at the mechanics of the transition, specifically the decoupling of the paper mark from the gold mark and the roll silver, played as a survival asset. In 1914, before the war, the German mark was a solid currency backed by gold with silver coinage in wide circulation. A 5-mark coin was 90% silver. It was money. It was heavy. It had a sound when you dropped it on a counter. By 1919, the war was lost, the Kaiser had fled, and the new republic was saddled with crushing reparations payments. Denominated in gold and foreign currency, the industrial base was intact, but the financial balance sheet was obliterated. The government, facing the impossible choice between austerity, which would lead to revolution, and printing money, chose the printing press. At first, the effects were euphoric. Exports boomed because the currency was cheap. Employment was high. The stock market soared in nominal terms. A disconnect emerged that is critical for us to understand today: the difference between the nominal price and the real price. In 1921 and 1922, the liquidity in the paper mark was massive. There was cash everywhere. But the liquidity in real terms, the ability to convert that paper into hard assets, began to dry up. Foreign banks stopped accepting the paper mark. Suppliers demanded payment in dollars, pounds, or gold. The internal combustion engine of the German economy was running on paper oil. The specific mechanism of the collapse was a feedback loop of velocity. As confidence waned, people spent the money faster. The faster they spent it, the more the government had to print to maintain liquidity. By late 1923, the system hit a terminal velocity, but here is the detail often missed: the flight to silver. As the paper mark evaporated, the old silver coinage from the empire, the coins that had been stuffed into mattresses and buried in gardens in 1914 suddenly re-emerged. People realized that the paper price was a fiction. A 5-mark silver coin, which legally had a face value of 5 marks, was being traded on the black market for millions, then billions of paper marks. The squeeze was the sudden realization that the paper derivative was worthless. There was a story recorded by a clerk in Berlin of a woman who went to a bakery. The price of a loaf of bread was one price when she entered the line and double that price by the time she reached the counter. But the man behind her, who produced a single silver link from a chain, was given the bread, the rest of the stock, and a deferential nod from the baker. The silver represented settled value. The paper represented a claim on a bankrupt state. The liquidity crisis in Weimar wasn't a lack of paper, there was too much of it, it was a lack of trust. And when trust vanishes, liquidity in the fraud evaporates while the price of the truth goes vertical. The paper market continued to function technically, the presses ran, the banks opened, but the mechanism of value transfer had broken. The society fractured into two classes, those with hard assets, silver gold land tools, and those with paper savings. The middle class, the pensioners, the bondholders, they were wiped out completely. Their wealth was transferred to the debtors and the speculators, who had positioned themselves in hard assets before the liquidity crunch hit. Just like the Weimar Republic discovered the difference between paper promises and metallic reality, the British Empire in the 20th century offers a more subtle yet equally devastating example of this pattern. This was not a hyperinflationary explosion, but a slow, grinding default, a controlled decline that slowly stripped the wealth from the population through the debasement of the coinage itself. For centuries, the pound sterling meant exactly that, a pound weight of sterling silver. It was the standard by which the world traded. A British silver shilling was a guarantee of quality. But the costs of World War I broke the back of the British Treasury. They had borrowed heavily from the United States and had shipped tons of physical silver across the Atlantic to pay for munitions. In 1920, the British government made a decision that marks the beginning of the end for any currency. They reduced the silver content of the coinage. The Coinage Act of 1920 reduced the fineness of silver coins from 925 sterling to 550%. It was a technical move justified by the high price of silver at the time. The government argued it was necessary to prevent the coins from being melted down. But in reality, it was a default. It was a 425% tax on the money supply, executed not by the tax collector, but by the mint. The population didn't revolt. The new coins looked the same. They were the same size. They had the same king's head, but the sound was different. They didn't ring as true. The squeeze here was slow motion. Over the next 2 decades, as Britain faced the Great Depression and then the existential threat of World War II, the pressure on the currency mounted. The final break came in 1947 to pay back the massive silver loans from the United States under the Lend-Lease program. The British government needed physical metal. They couldn't print it, they had to find it, so they demonetized silver completely. The Coinage Act of 1946 mandated that all silver coins be withdrawn from circulation and replaced with cupronickel base metal slugs with zero intrinsic value. The government needed the citizens to hand in their pre-1947 silver coins so they could melt them down, extract the silver, and ship it to America to settle the debt. This was a squeeze of the highest order. The government was short silver and the population was long. The incentive structure was set. The government used propaganda and the banking system to vacuum up the real money and replace it with tokens. Those who understood the pattern, who saw that the 500 silver coins were being replaced by base metal, hoarded the silver. They refused to deposit them. They kept the real money. Today, a pre-1947 British shilling is worth roughly 80 to 100 times its face value. In purchasing power terms, the paper pound has lost over 99% of its value. Since then, the liquidity crisis of the British Empire was solved by confiscating the real wealth of the people through a voluntary exchange that most didn't understand until it was too late. The squeeze was the government covering its own short position by draining the liquidity of the public's hard assets. The pattern repeats in 7 distinct stages. The arithmetic is merciless and the sequence is fixed. Stage 1 is sound money. The currency is the asset. A coin is gold or silver. A certificate is a warehouse receipt, legally binding and instantly convertible. Trust is absolute because it is verified by physics, not politics. Stage 2 is the paper promise. To fund expansion or war, the state issues paper claims that exceed the metal in the vault. This is the birth of fractional reserve banking. The population accepts the paper because it is convenient, and for a long time the convertibility is maintained. The disconnect is hidden. Stage 3 is the expansion of leverage. The economy becomes addicted to the easy credit provided by the paper claims. Derivatives are created. Contracts are written on top of contracts. The ratio of paper to metal expands from 2 to 1 to 10 to 1, then 50 to 1. The financial sector grows faster than the industrial sector. Stage 4 is the warning tremors. Inflation begins to tick up. There are brief periods of shortage. The spread between the paper price and the physical price of the asset begins to widen slightly. Smart money. The Insiders, the central banks themselves, begin to accumulate the physical asset while publicly extolling. The virtues of the paper stage 5 is the liquidity lock. This is the critical moment. A catalyst event occurs, a war, a policy error, or a calendar quirk, like a holiday week where liquidity in the paper market dries up, the sellers disappear, the algorithms pull their bids. The market becomes limit down or simply freezes. Holders of paper contracts try to stand for delivery, demanding the physical asset. Stage 6 is the squeeze. The realization hits that there is no metal. The vault is empty, or the metal is rehypothecated to 5 different owners. The price of the physical asset decouples completely from the paper price. Premiums explode. You might see the spot price on a screen at $25, but you cannot buy an ounce of silver. For less than $50, the paper market becomes a zombie walking but dead. Stage 7 is the reset. The system forces a settlement. This usually involves a default on the paper promises, settling in cash at a suppressed rate or a revaluation of the metal to a price that clears the market. The currency is often reformed, zeros are lopped off, or a new backing is introduced. Wealth has been transferred from the paper holders to the physical holders. Just like the Spanish Weimar and British examples, we are currently standing on the precipice of stage 5. The mapping to the present day is precise and the warning signs are blinking red. Current data suggest we are approaching a liquidity event of significant magnitude. The focus is December 26th, a date that historically represents a period of extreme thinness in global markets. The major bullion banks, the market makers, and the institutional desks in London and New York are operating with skeleton crews. Volumes are low. In this environment, the algorithmic trading systems are dominant, but the structural setup going into this specific window is unique. We are seeing a historic drain on the COMEX registered silver inventories. The registered category silver that is available for immediate delivery against a futures contract has plummeted. Estimates range, but some analysts point to a decline of over 70% from the highs. The ratio of paper ounces traded to physical ounces available has stretched to levels that make the Spanish Empire's leverage look conservative. Furthermore, we must look at the exchange for physical or EFP mechanism. This is the release valve the market uses to prevent a default. When a large trader wants delivery, the banks often convince them to swap their futures contract for a position in the London over-the-counter market, effectively kicking the can down the road. But the London vaults are also reporting stress. The flow of silver is moving east to India and China at a pace that Western markets are struggling to match. The December 26th liquidity crisis thesis rests on the idea that a sudden geopolitical shock or a margin call ripple effect during this low liquidity window could force a scramble for collateral. If a major entity stands for delivery and the metal isn't there, the paper price is irrelevant. A squeeze happens in the premium. We could see a scenario where the spot price drops or stays flat due to paper selling, while the cost to actually acquire a 1,000-ounce bar jumps by $8 or more overnight. This is the bifurcation of the market. Critics will argue that this is alarmist. They will point to the fact that the COMEX has never technically defaulted. They will say that the bullion banks have deep pockets and can always manage the price. They will argue that silver is an industrial metal, not a monetary one, and that supply can always be ramped up from mining. But this counterargument ignores the incentives and the arithmetic of the current moment. Mining output is inelastic. You cannot ramp up a silver mine overnight. It takes 10 years to bring a new mine online. The deficit in silver supply has been persistent for years. The above-ground stockpiles are being depleted. The incentive for the bullion banks is to suppress the price to cover their short positions, but they are fighting against the gravity of physical shortage. And regarding the never defaulted claim, every exchange works until it doesn't. The London nickel squeeze of 2022 showed us exactly what happens. The exchange simply canceled the trades. They broke the rules to save the banks. If that happens in silver, the paper contract becomes worthless and the physical metal becomes priceless. The risk is not that the casino closes. The risk is that you are left holding chips when you thought you held money. The endgame approaches in one of 3 ways. The first is controlled decline. The powers that be manage to hold the peg, allowing the price to rise slowly, managing the inflation and burning off the real value of the debt over a decade. This is the British Empire model. You lose your purchasing power, but you don't lose your society. They set a fixed much higher price for the metal to recapitalize their central banks. This is the Roosevelt 1934 model for gold, or a modern CBDC implementation where the old system is fenced off. In 1933, Franklin D. Roosevelt issued Executive Order 6102 forcing the surrender of gold. The price was then revalued from $2,067 to $3,500. Those who held the physical asset outside the system preserved their wealth. Those who held paper claims or surrendered were devalued. The only variable is timing and pain. The mechanism is set. The leverage is absolute. The liquidity window is closing. Subscribe to the channel. Preparation is not about panic, it is about education. Watch the premiums, not just the spot price build. Resilience in your skills, your community, and your understanding of history. It only cares if you are standing in its path.